Hello and welcome to our end of January update from the Wealthy Doctor Institute. Intelligent investment for the busy professional. We focus on simple battle-tested methods of investing that require just one adjustment each month to protect and build wealth. I'm David Ye, author of my book, The Busy Doctor's Investment Guide, How One Adjustment Per Month Can Save and Maintain Your Portfolio's Health. Although the strategies in this book are easy to calculate and adjust each month, for those of you who are new to the concepts in this book, or for those who are new to investing in general, this video will try to clarify what I do each month. Feel free to follow along every month until you get the hang of it. So what a month! We're going to have an abbreviated report this month, and that's because we have action steps in all our systems. And I would rather get an abbreviated video out earlier rather than risk delay with also answering a question of the month. So let's get started with the first system. The first system I'll cover is the 20-month simple moving average system. I abbreviated 20-month SMA or 20 SMA. And the way this works is if the S&P 500 index fund is above the average price of the fund over the last 20 months, then it's relatively safe to stay invested in the index fund. Otherwise, get out. The 20-month moving average is our safety belt. It only works if we watch it once per month. So here's our updated chart. For the last month here, the index actually went down below the 20-month moving average. The mutual fund that I use to calculate these calculations for 20-month moving average on the index is the VFINX. You don't have to use the VFINX. You can use any S&P 500 index fund. There are plenty out there. This particular fund happens to be the oldest, so it has more data for me to work with. And no, you do not need a lot of data to work with. It's just that for me, in terms of backtesting, it's a lot easier. And the fund ended this month with a price of $179.10, which is less than the average price of $184.48. So based on this system, it's time to rotate out of the index fund and into your choice of either cash or bonds. So analyzing what happened this month is a very good exercise in how psychology can really play tricks on us. So for instance, in the beginning of the month, our index was above the 20-month moving average. And lo and behold, after just 1 week, we dived below this 20-month moving average. I started getting calls going, well, the index is already below the 20-month moving average. Shouldn't we be selling now? Well, here's the problem. If it went down 1 week, is it possible that the index can go up again the next week? Yes, and in fact, if it does, it's called a whipsaw. Every time we whipsaw, like how I described last month, every time we whipsaw, we actually lose money. So if we follow 1 month and see where it ends up at the end of the month, it's a much cleaner system. And in fact, some people were noticing the stock market has been dropping 2 or 3 weeks after the drop, in which case it's dropped 10%, but now it's gone up again. So here's another way the data can trick our minds. Over the last week and a half, the markets have been going up, and now, even though the system says sell, people can look at this and go, well, it's been going up. Shouldn't we kind of wait and see? Well, you can't have it both ways. Either you follow the system, or you use another system, but don't go with your gut. If you go with your gut, you're going to kill your portfolio. So once a month, clean signals, discipline. So next system is the monthly rotation investment system, or the MRI system. This is a completely different system compared to the 20-month moving average. It has nothing to do with the 20-month moving average. This system has to do with rotating between 3 funds. You can have your own variations using however many number of funds you want. Just remember, every time you add another fund, the calculations become that much more complex. So for this system, every month you have three funds: the S&P 500 Index Fund, their Emerging Markets Fund, and the Inverse S&P 500 Index Fund. You rank these funds based on momentum, in other words, how much they went up or down. Then sell the bottom 25% of your portfolio and use those funds to purchase the top fund of the month. So for this month, ending prices of the S&P 500 Index, the Emerging Markets, and the Inverse Fund, compared to this month, we see that the S&P 500 Index lost 5%, the Emerging Markets lost 6%, but the Inverse Fund gained 5.7%. So here's a graphical representation of what's been going on this past month. So if you recall, last month we were, according to the model, 50% inverse fund, 50% index fund. So if we were to sell the bottom 25% of our portfolio and buy the top fund, we would now be 75% inverse fund, 25% index fund, roughly. So remember, if one index fund cancels out one inverse fund, if last month we were 100% cash, we would be effectively 50% cash and 50% inverse fund. Our next system is the 1% trailing risk stop system. Now remember, this 1% refers to risk of the total portfolio, not the stock itself. Remember, the stock itself, we have a 25% trailing stop loss, but we have to position size so that the stock only takes down 1% of our total portfolio if it ever reaches that stop loss. So the rules are, if you really want to buy a stock and you don't want to risk 1% of your portfolio on any one stock, and you have a 25% trailing stop loss order, that means you can buy up to 4% of your trading account of that one stock. This way, if you buy 4%, it goes down 1%. That's 25% of the stock. Conversely, if the stock goes up 33%, then your trailing stop loss has reached your purchase price and effectively neutralizing your risk. So you can go ahead and buy another block of stocks using another 4% of your account, and therefore gaining more as the stock goes up, and yet still only risking 1% of your portfolio on that one stock. And repeat until you're actually stopped out, which hopefully will be years from now, if ever. But at least you have that seatbelt. So there you have it. Remember, we went over 3 different systems. Keep them separate, don't mix them together. Systems only work if you diligently do them, even if it's only once a month. Discipline is key. Having a plan is key. Going with your gut is deadly. So keep those questions coming. I know I didn't go over a question a month this month, but next month I will. I know I talked to several of you personally each month, but for those of you who have only heard about me indirectly, maybe you got a copy of this video forwarded to you by a well-meaning friend or colleague, here are ways to get in touch with me. Seriously, drop me a line, give me a call, email me to set up a consult. A few of you I've talked to, you know your stuff, you're fine, I don't have to worry about you. But for some others, holy cow, it's clear you need help getting your financial life in order. Don't be bashful reaching out for help. The more you delay, the more time is against you. So, until next month, invest safely.